Hello, everyone. Don Garman here from Mirador Capital Partners. Here solo today. Thought I'd take a couple minutes just to update you as our investment committee for the week just concluded, and also to point out a couple of interesting factoids. So today is, you're probably aware, August 25th, which makes it the 6-month anniversary from the market low on March 25th. And this is a very interesting time, 6 months down the road, to kind of look back and make some observations about the market, the economy, the general investing backdrop. I think it's okay to draw some general conclusions about kind of where we've come and, more importantly, where we're going. So what I would say is that obviously from January to the end of March was a period that would be characterized with growing fear and uncertainty about the path of the virus, the closing of the economy and its effects. And we had gone into the year with some concerns about general debt levels and came into the year in a pretty hedged position, which accounts for why we didn't have that same, level of catastrophic panic and doom a lot of portfolio managers and clients felt in March. And we know now hastened the permanent, adjusting of portfolio strategies that had been a couple decades in the making. So we didn't ever have to do that. And then, as it looked like a large swath of American companies, large companies, established companies, were going to go bankrupt, the Fed stepped in and said, we are going to be the buyer of last resort of corporate bonds, basically high grade, high quality corporate bonds. And looking back, that changed everything. Just the perception that the Fed would be there to step in and buy that debt meant that those companies were going to be able to limp through, which gave them time to go raise equity capital and additional debt, which is what a lot of them have done, and kind of changed the direction of the narrative from straight down to, one where we could get into time to adjust, recover. Then, of course, the government came to the rescue with unemployment and some additional unemployment compensation, which we know ran out at the end of July. And, everyone expected that when that ran out, there was going to be another turn. And then here we are, in late stages of a negotiation for a new package. And so all that is to say, the economy itself is still in rough shape. We know that if we go downtown, and now we've got fires to contend with. So where we could at least go out and dine al fresco downtown a couple weeks ago, now we're not doing that anymore either. So you don't want to stay inside because that's where the virus works best, and you can't go outside because that's where smoke damage works best. So we're all in this kind of, holding pattern. Yet the stock market, as you've all seen in your accounts, and we've discussed with many of you, have fully recovered, and many of our strategies are now up handsomely for the year. And so we are in clearly a new narrative. And so what I just wanted to highlight is, you're starting to hear some talk about the comparisons to 1999, and I don't want to go overboard in talking about that too much here, because there is a big difference between Amazon and Google and Facebook and Pets.com and all the companies of the era that came to sort of symbolize the excesses and the bubble that we confronted now looking back during that time. So I don't want to draw too many comparisons about that now, but we do see pockets of speculation. I was relaying to the committee that I had a conversation with somebody just yesterday about, them taking a substantial amount of money, in my opinion, and putting it in a battery of companies that they didn't know what the companies were or what they did. And so there's no better definition of speculation than taking a large chunk of money and putting it in something that you don't even know what it is. that is basically what speculation is. That's what it means. So, but this is important. What we've also talked about over the years is that certainly the long view strategy is a place where you're always going to find companies which we believe to be high quality companies that will be larger, over a 3 to 5 year period in the future than they are today. That should always be the case. And anytime you see a company in there, it is a direct, it's a signal. It's the most direct signal we can provide that we think that is a company that will be larger in 3 or 5 years than it is today. And in our case, we think it could be quite a bit larger. So why I bring that up and what I'm highlighting in this comment is that we do believe, looking back to today from 5 years from now, the very definition of quality will have changed. So there will be airlines and cruise lines and hotels and all of those things will still exist, and malls. They just will be a lot different in size. And the road from here to there will make the investment pathway uncertain and sort of fraught with thorns and things that we might be unpleasantly surprised by if we try to take that path. So, but we do think that there will be a new cohort of winners that you'll see and are seeing are populating the strategy now and will continue to, certainly over the remainder of this year, price opportunities permitting, that we think, we will look back on in this era and be glad we owned and be willing to ride out some price volatility if we get that. I was lamenting in the committee today that some of the things I wanted to add, but, was getting very picky about the price that we were paying a couple months ago. Certainly, I wish I had pulled the trigger on sooner. So we're going to be shifting the focus of the strategy, not from a, what will hold up best in a recession, because that trade, the opportunity to benefit from that trade was really in how individuals interpret terrible financial news, which we've certainly gotten. But the interpretation of investor behavior has been different than it has been in the past, with similarly, in fact, less bad news. So that, I think, is a recognition of bond yields are really low, cash yields virtually nothing, hard to invest in commercial real estate right now, not knowing everybody's cutting their real estate footprint. So, places to go with capital, which is abundant, are a little less clear, and buybacks have continued throughout. So companies take their stock out of the supply, and it does create certain support for pricing. So it makes the valuations unpleasant, but in some sense, we have the protection of a lot of different ways we can get exposure to things without, going into owning all of 4 or 5 things and hoping and praying that those 4 or 5 things work, or else we're out of luck. We are never going to be in that position. Not now, not ever. So this will not be one of those times, but you will start to see new positions, ones you may not have heard of or recognize, start to populate here in the coming weeks and months. So I'm going to leave it there for now. And maybe next week we'll start to go back to some combination of multiple people, but for today it was just me. Hope everyone's safe. Hope you scrapped through our COVID summer and managed to have a little fun and spend some socially distanced time with family. And until next time, thank you very much, and we will talk to you soon.